What's up, YouTube? Welcome back to Not Dumb Money. At the time of this recording, stock markets witnessed a sharp sell-off. Tech stocks have been hit especially hard. The tech-heavy NASDAQ composite fell 6% in just 2 days. And over those 2 days, stocks I personally own dropped even more. Yes, I know, I have a lot of tech exposure in my portfolio. But I'm not worried. And in today's video, I'll explain why. I'll use history to illustrate why sell-offs, crashes, periods of volatility, or whatever you want to call it, are not a big deal if you're able to take a long-term perspective. But first, if you're not a subscriber, please show me some love and subscribe. That would be awesome. If you're already a subscriber, thank you so much. All right, so let me start by explaining what long-term means to me. Long-term to me is at least 10 years, maybe even 20 years. When I say I'm a long-term investor, I'm investing for my retirement. I've been investing in the stock market for almost 10 years already, and I have way more than 10 years left before I retire. I'm not betting on stocks to pay for expenses. I invest my savings. I always tell people not to invest money they need to spend. It's too risky if you're not able to take a long-term view. Okay, let's go back in history and look at some of the worst crashes in recent memory. There's 1987's Black Monday, the dot-com bubble in 2000, the financial crisis of 2007 to 2008. Let's start with Black Monday. Back in 1987. Let's assume you started investing right before the crash. You decide to invest, and markets crash the next day. Worst case scenario, right? But let's take a long-term perspective. At its peak, the Dow reached 2,722 points in August 1987, and that's what you paid for it. Markets then started to decline. On October, they started to decline even more, and then came Black Monday, October 19th, 1987. The Dow was now at 1,738 points. The investment you made in August just 2 months ago is now down 36%. By the end of 1987, you're down 28%. 1988 goes by. You're still down 20%. By the end of 1989, you finally have your money back. But it took you 3 years to get a return of just 1%. But let's fast forward to 10 years from when you invested. Let's go to 1997. The Dow is now 7,916, and you have a return of 191%. It's not bad, right? Next up, the dot-com bubble in 2000. The internet was all the hype in the late 90s. Remember pets.com? The tech-heavy NASDAQ composite peaked in March 2000 at 5,048 points. Again, let's assume that's when you invested. By the end of the year, as the hype was dying down and the dot-com bubble burst, you're down 51%. At the end of 2001, you're down 61%. It gets worse. By the end of 2002, you're down a whopping 73%. But you are patient. You know why? Because you're a long-term investor, and in this case, very patient. It takes you 15 years just to get your money back. But 20 years after your investment, you are up 54%. Today, you are up more than 120%. I think you get the idea. Again, if you bought the Dow in October 2007 at its peak before the financial crisis of 2007 to 2008, you would have been down 6% in a couple of months. Within a year, you'd be down almost 40%. But 10 years after your investment, well, you would be up 75%. Today, you would be up by around 100%. Okay, so those are my 3 examples. Even in the worst case scenario of buying peaks right before crashes, you still would have made a long-term return. So that's it, guys. I hope you found this useful. And I'll wrap it up by quoting the very, very wise Yoda. "In a dark place we find ourselves, and a little more knowledge lights our way." That was a terrible Yoda, but you get the point. Thank you so much for watching. What are your thoughts on stock market crashes? Does high volatility bother you? Do you have a long-term view when investing in the stock market? Please let me know down in the comments. If you like this video, please do me a huge favor. hit that like button, subscribe, and turn on the notifications bell. As always, it's been a pleasure. Much love. Peace.